While demand continues to outpace supply relative to historical averages, and the HPI benchmark price increased a further 1.3% in the month of June, we did start seeing a shift over the last few weeks. Is this a sign of the slowing summer market typical for this time of year, or has our market reached and passed its peak and now declining? I'm Adina Dragasanu with Adina YVR Vancouver Real Estate Group and OAKWYN Realty, here with your July 2023 market update. Let's start off looking at sales. The Real Estate Board of Greater Vancouver reported that there were 2,988 sales in the month of June. This is an increase of 21% relative to June of last year, but it's a decline of 12% relative to May, and it's about 8.6% below the 10-year sales average for the month. On the supply side, there were a total of 5,348 homes newly listed for sale in the month of June. This is an increase of 1.3% relative to this time last year, and it's a decrease of about 5.5% relative to May. If we look at it compared to the 10-year sales average, we're about 3.1% below the 10-year sales average for the month. This brought the total supply of homes available for sale in our region up to 9,990. This is up about 7.5% relative to May, although it's still down about 8% relative to this time last year. And if we look at it compared to the 10-year sales average, we see that it's about 17.4% below the 10-year sales average for the month of June. And looking at specific submarkets that our team services here in Vancouver, we noticed that this was the first month of the year that we saw double-digit sales declines in certain markets and inventory increases. Starting off with the downtown condo market. We saw that the number of sales decreased by 18% in the month of June relative to May, and inventory increased by 1%. On the west side of Vancouver, we saw detached sales decrease by 33%, while inventory increased by 4%. And the attached segment on the west side also saw sales decreasing by 8%, while inventory increased by 6%. Looking at the east side of Vancouver, we see that the detached market saw sales decreasing by 23%, while inventory increased by 13%. With the attached segment on the east side being an anomaly, with sales increasing 1% while inventory decreased 1%. Even North Vancouver, which has been one of the most heated markets for the detached segment, saw decreases in sales of 15% while inventory increased 9%. And the attached segment in North Vancouver saw sales decreasing 11% while inventory increased 5%. So let's take a look at what's happening with prices. The HPI benchmark price for all property types is currently at $1,203,000. This is up about 1.3% relative to May, and it's a decline of 2.4% relative to this time last year. Looking at this by property type, we see that the HPI benchmark price for detached homes is currently at $1,991,300. This is an increase of 1.9% relative to May, and it's a decline of 3.2% relative to June of last year. For attached townhomes and duplexes, we see that the HPI benchmark price is currently at $1,098,900. This is an increase of 1.5% relative to May, and it's a decrease of 1% relative to June. And for apartment condos, the HPI benchmark price is currently at $767,000. This is an increase of 0.8% relative to May, and it's an increase of 0.5% relative to June last year. So where do we go from here? To understand what's happening with prices and where they're headed, it's important to look at the sales to active listings ratio. If you recall, this ratio looks at the number of sales in a given month divided by the total active listings left over at the end of that month. When this ratio is below 12%, we typically see downward pressure on prices, and when this ratio is above 20% for a sustained period of time, we typically see upward pressure on prices. In the month of June, our sales to active listings ratio was 31.4%. So we're still very much in seller's market territory. However, this is a decline of about 7% relative to May. By property type, the ratio is currently 20.9% for detached homes, 38.5% for townhomes, and 39.4% for apartments. And looking at these numbers, they reaffirm what we've noticed in the last few weeks. And that's that the fundamentals of the market are still very strong, given that we have very low supply and high demand. However, we're starting to see market activity slow down. And this seems to be compounded now that interest rates are increasing yet again. While everyone's aware that the Bank of Canada increased its variable rate by 0.25% in June, what many haven't been talking about is how much fixed rates went up. Between May to June, we saw fixed rates go up 0.8% at most major banks. For most borrowers, this led to an increase of about 8% on their monthly costs. It's clear how this is impacting homeowners, but something that's not talked about is how this is impacting the rental market in a very significant way. Rent prices in Vancouver have increased 10 to 25% relative to this time last year. The median rent price for studios is currently $2,375, up 25% relative to last year. For one-bedroom condos, the median rent is currently $2,800. This is up 17% relative to last year. For two-bedroom condos, the median rent is currently $3,800, up 12% relative to last year. And for three bedrooms, it's currently $4,900, up 11% relative to last year. While these rent prices seem astronomically high, what's not being talked about is that for investors looking to purchase rental property in the market right now, the numbers still don't make sense. For an average investor, if you were looking to put 20 to 30% down payment, you'd be having to subsidize up to $500 to $1,000 out of your own pocket just to hold that property. So let's take a quick example. The average purchase price for a small condo here in Mount Pleasant, about 500 square feet, is $650,000. If you were to put 20% down payment, you'd have to mortgage about $520,000. With current interest rates at 5.8%, this would lead to a monthly payment of $3,265. On top of that, you need to add property taxes and strata fees, so say about $350, leading to a carrying cost of $3,615. If you were able to put 30% down, this total carrying cost drops to about $3,207. With the average rental in Mount Pleasant being about $2,600 a month, it's still not nearly enough to cover your carrying costs as an investor. And unfortunately, there isn't much relief in sight because these high interest rates also make it very challenging for investors to build new rental housing. So with all this said, what does this mean for you if you're looking to buy or sell? While the market has changed at a faster pace than we expected this year, the fundamental message remains unchanged. If you're looking to make a move in real estate, whether that's buying or selling, you need to look at this as a long-term investment and make a decision now based on those long-term fundamentals. And the long-term fundamentals of our market is that we still have the highest population growth in Canada that we've ever had, and the inventory of new housing that we need to sustain that population growth is not keeping up. So while we're facing some uncertainty in these next few months as we adjust to new interest rates and possible future hikes, it's almost undoubtable that prices are going to continue to increase in the next 3-4 years. So if you're a first-time buyer or looking to move up the market, this could be a great opportunity to try to get in the market while it slows down, get yourself a great deal, pay a higher interest rate now, but refinance in a few years when they come down and get ahead of the market. If you're looking to make a move this year, you can schedule a consultation with me by clicking the Calendly link below in this YouTube video or the link in my bio here on Instagram. And to stay up to date with what's happening in the market, be sure to subscribe here on YouTube and follow me on Instagram at adina.yvr. Have a great rest of the month, and I'll see you in August.